Hi, my name's Hamish Patel. I'm a mortgage broker in Auckland. I've been in the banking and mortgage broking industry for about 20 years. I wanted to talk to you today about my thoughts on capital gains tax. Couple of aspects of it really. One of them, of course, it's been thought about before, which is basically the lock-in effect. So just to break it down for you, imagine you have a property in Auckland. Let's say it's a rental property, and let's say it is in an area which predominantly used to be mainly a rental area. So let's say it's in a suburb like Mangere, right? And it's worth something like 500. Now, over time, let's say you own that property, and over time you realise that there's a lot more owner-occupiers moving into the suburb. You feel like maybe you could find a better place for you to have your money invested, somewhere where maybe the rent would be a little bit higher compared to what you invest. So you start to consider maybe selling up and buying in a different suburb. Now with a capital gains tax, you will have less capital for the next property, right? Because you're using money as a medium, basically, to move from one asset to another. So effectively your next house that you buy will have to be a cheaper property. Now, what impact does that have on the psychology of a person? Does that make capital a bit stickier? And this is just one example, but of course we have to consider what effects it has on specific types of industries and specific types of property and assets. The other thing I want to discuss as well is really the impact it will have on future government policies, because let's face it, once you have a capital gains tax in place, as a government you'd have to think long and hard about introducing a policy which may mean more stable or diminishing house values, because it's going to have an impact on your tax take, right? Now, is a capital gains tax, if you're not sure about the prices, future prices, and the volume of things traded in the future, is it something you can rely on enough to then reduce other taxes? Because if it isn't, it just becomes a very insecure kind of tax, really. I guess fundamentally the other issue I have with capital gains tax is the fact that it is really punishing people from trying to shelter away from inflation. Now I know that if we look at the CPI, inflation has been fairly low over the last 10 years, but if you really think, at a time when there has been massive money creation around the world, money supply has increased, it's no coincidence that house prices and shares have shot up. You can't blame a New Zealander for trying to build up their wealth and basically not hold it in cash, okay? Because obviously you could buy less today than what you could do 10 years ago with that cash. So are we doing the right thing by punishing someone for having to use cash for what it was designed to do? So you're trying to move from one asset to another. You use cash as a in between, and do we say that that's we need to clip the ticket on that and take a portion of that cash away? So those are my thoughts. Thank you for listening, and have a good day.